Next up, we have David Neckar, Client Director at Willis Towers Watson and also a member of the Insurance Committee at ITFA. David will be covering a risk and insurance perspective, looking at the present and future impact on capacity, coverage and business models. David, over to you.
Good morning. My name is David Neckar. I work for Willis Towers Watson, one of the three large global insurance brokers, in the specialist division entitled Financial Solutions. We deal with political and credit risks for banks, corporates, and traders, and we have a long experience of this class of business. However, our long experience has not ever seen anything like what we're facing today. And so it's difficult to answer some of these questions without having to confess beforehand just how awkward it is in times that are so fast-moving and unprecedented. But I'll do the best I can to give you a sense of how we see things and where these various questions that have been put to me may help us to deal with the challenges we're currently facing. So the first question is about the current state of the trade credit insurance market. I've tried to give a sense of the attitudes that the insurers are showing in these very difficult times. A structured credit insurer said, we are open for business. They made allusion to the difficulties in particular that the oil price fall is causing. A trade credit receivables insurer said that they are working hard to ensure smooth delivery of services, which is reassuring. And in particular, they provided immediate policy amendments to give clients greater flexibility to manage payment delays. So these are to be welcomed as signs of business as usual, as far as usual can be described in any terms these days, and flexibility for difficult situations. However, it is clear that all insurers are being cautious and are sending signals out to the market that current offers of cover are to be revalidated and reconsidered. Only one insurer has actually made a blanket halt on their existing offers of cover. So the general pattern of the 50 or so platforms that we deal with in this broad and specialist area is of trying very hard to be open for business and to be careful in their consideration of risk. And to some extent, I would say that the insurers are also hoping to receive back from their clients useful feedback on how the client activity is changing to deal with these challenges. Turning to the question of where the biggest risks lie for both FIs and corporates, now that's a very broad question. And I think to start with, one might say, let's look at where are the biggest risk exposure areas. And in the market, they have been typically in the sectors of oil and gas, aviation, financial institutions, autos, retail, and leisure. Those are key sectors where there have been exposures for both the medium-term single risk credit underwriters and the trade credit receivables players. And in particular, certain countries have been key exposure concentrations. African oil-dependent economies, China, of course, Turkey. So inevitably, those are likely to be biggest risk areas and areas of concern for the insurers. The types of insurance exposures that they have range from short-term letter of credit receivables cover through to medium-term syndicated loans, bilateral loans, to corporates and sovereigns, and on to much longer-term exposures of project finance and asset-backed risks such as aviation. Now, in 2009, which is one of the few areas we've got to make some form of comparison, the short-term, medium-term exposures became rapidly either claims and serious problems, or serious problems that were capable of being resolved by reschedulings. There was relatively little in the way of long-term exposure at that time. In the intervening years, the insurance market has gone to much broader coverage, including long-term aviation-type risks, for example, and project finance risks. So one of the questions here is just how far the extraordinary challenges that are coming from all types of risks, both all sectors and all countries, are likely to be under pressure. How far will these complex additional layers of cover put pressures on the insurers to deal with their much more complex set of challenges than they've had before? So I think the biggest risk may well lie in the operational pressures, where the front-end underwriting resources are going to be stretched because they will be required to work on workouts and claims. One should bear in mind it won't necessarily be the obvious risk issues that will be a concern, but it will be in getting to grips with the insurers having to manage a wide selection of complicated problems. Now, turning to the third question, is there enough capacity in the market to support the demand? That is a very difficult question at this stage, because we simply don't know how demand is going to evolve. But typically, capacity in the market is something which tends to be a topic of conversation and concern, because it tends to aggregate and concentrate in what one might describe as the usual suspects, difficult areas where many insurers find that they are being solicited for cover, such as African oil exporting countries, Nigeria and Angola, or Turkey, for example. So that capacity has always been subject to the question, well, subject to the observation, there's not enough capacity for this. But one must bear in mind that insurers have careful management procedures for their portfolios, and therefore they must also take into account the reinsurances that are available. So to date, the capacity has been good for the demand, but up till now, we have not faced the kind of global, all sector, all country potential problems. And therefore, all one can look to is to say, well, let's step back and see how the market is evolving. And my most positive comment here, in terms of hope for adequate capacity for the future, is that the regular market survey, which WTW carry out every quarter, admittedly the most recent one is just prior to the COVID-19 virus explosion, showed that capacity for 2020 had grown despite the fact that under much tighter insurance and reinsurance conditions at the latter part of 2019, which led to some participants pulling out of the market, there were some new entrants, and there was a slightly increased capacity. We're talking about figures which are significant. On any one risk, 3.2 billion notional capacity for non-honouring of sovereign, what we call contract frustration risks, 2.4 billion for credit private obligors, and 3.1 for general political risks. Now, those are the aggregate theoretical maximums added up, which is the standard method the market uses to track its aggregate potential capacity. So a slight increase. On that basis, despite awkward and difficult conditions at the end of 2019, with stress in many areas, economic stress and political, the market was still showing a good increase of capacity. And I think that's the most comforting thing we can say in answer to, will there be enough capacity to support the demand? Turning to the fourth question on the next slide, what should users be doing to manage their ongoing demands? This is a critical critical moment for people who have been active in this credit risk mitigation area. Because for pending transactions, insurers are going to need to work very closely with their brokers and with insurers to revalidate cover and ensure that transactions which are already maybe quite close to being consummated can go ahead. But they will be subject to review and amendment. And it must be clear to anyone who's been in this business for a while that there are some risks which are perhaps under pressure and maybe were already difficult to find capacity for, which will need to be very carefully handled in order to make sure that the underwriters go ahead and actually provide cover. That may prove problematic. But for existing business that's already on the books, users need to give regular updates to their insurers, and especially where, if those risks get into difficulty, they need to discuss with their brokers how best to get the information across to insurers in a consistent, measured, and effective way, bearing in mind the claims provisions of the policies. This, as I've said, is a critical area. One could say that this principle of communication to, apologies to Tony Blair, is absolutely essential. The most successful users of insurance, as I'm sure that those who are banks and traders and corporates out there will recognize, are, when they deal with clients, are those banks and corporates who have a good working relationship with their insurers and treat them as risk partners. This is an area where brokers have a key role to play in making sure that traffic is managed in a sensible and efficient way. Messages that, in this particularly potentially febrile environment, need to be carefully considered and explained cautiously to insurers, who in turn are making cautious risk judgments. I think that one has to bear in mind, in particular, on a practical note, that for a bank or a trader or a corporation to be able to communicate effectively across what is now 50-something insurance platforms in a remote and virtual community is a challenge. And it's one that brokers it's their responsibility and it's their job to rise to that occasion and provide good communication in two ways, obviously, not just about the additional risks that the risk climate, but also about the financial and the operational response that insurers that clients would expect of their insurers to check their solvency and their ability to respond rapidly. So communication and observation is critical here. Finally, what changes might happen in the market? Will insurers' appetite change? This is an impossible question, really, to answer with things moving as fast as they are. But let's remind ourselves that they have taken, to date, a strong open for business approach, confirming their underlying commitment and appetite for this class. Any changes that in their appetite will depend upon how key sectors respond and whether they survive effectively. I mean, there are big questions around some of the hydrocarbon projects, some of which may have been already under stress some time ago. So insurers' appetites here are going to be clearly crimped by the difficult situations that some of those projects will be in. However, you must also bear in mind that these sectors were already subject in some areas to revised appetite because of the adverse trends with energy pressures, climate change pressures with rejection of coal and shift to renewables, and the excessive leverage of some of these entities. However, what we can go on, that's the only thing we've got, in a sense, to look at the way that the market responds under stress. We can go on the way that it responded in 2009 when it faced its major test as a fledgling market and was able to respond with $2.5 billion of claims, dealing with at that stage an extraordinary range of problems that they had not encountered before in very many countries and in many sectors. And they emerged from that with undiminished appetite and, in fact, undiminished solvency and financial security. Clearly, once this crisis is over, business will go on, and it will require a sensible and responsible approach for clients to recognize that insurers' appetite is conditioned as well on the way that those clients who respond responsibly and carefully communicate well, they will get better treatment from insurers subsequently. That was definitely the outcome of 2009. It's a factor which still persists. Reputations are made and broken in critical times. That's all I have to say at this stage, and I look forward to your questions.